My name is David Rogers, and I am a public and project finance attorney with Frost Brown Todd and president of its municipal advisory affiliate, FBT Project Finance Advisors. Joining me today are David Teed from Diogenes Capital and Amy Conderas from Frost Brown Todd. David also works with Oaktree Capital's Transportation Infrastructure Fund. Oaktree invests in transportation-related infrastructure assets in the sea, air, and land sectors, including seaports, airports, rail, and road projects. As an operating partner and senior advisor, David's role is to support investment teams to develop portfolio businesses. Amy is a public and project finance attorney with Frost Brown Todd and a CPA licensed in West Virginia. Her practice includes representing governmental entities and 501c3 organizations in tax-exempt and taxable financing and post-issuance and tax and securities compliance. Amy also advises on P3s, economic development incentive programs, and commercial lending. David Teed, thank you for being here today, and happy to have you open this video series, so please begin.
Thanks, David. I've been asked to talk today about the key characteristics of infrastructure and how communities can work with the private sector to address infrastructure needs. And the context in which we are having this discussion today is challenging. The deteriorating state of much of our infrastructure is well known, as is the important role that infrastructure plays in supporting economic growth. Less recognized is that most infrastructure is owned by state and local government, and state and local government are facing a budget crisis. The revenue impacts to state and local governments from this pandemic are still to be measured, but by some estimates will exceed $1 trillion through 2022, leaving reduced capacity to spend or to borrow for infrastructure. Will the federal government help? State and local government stimulus seems to be a partisan issue and is unlikely to be sufficient, leaving the budget challenge. On the other hand, infrastructure is not seen as a partisan issue and represents a possible bipartisan solution on several fronts. It's an opportunity to put Americans back to work, which would bolster flagging local tax revenues. It's a way to help address the funding crisis at the local level. And it's a way to address the large infrastructure deficit, including deferred maintenance and much needed new construction. The incoming administration's new Build Back Better plan includes infrastructure funding, and so we can expect some funding will come from the federal government, but likely not enough. And so there is a role for private capital. And the incoming president has spoken in support of public-private partnerships, providing a basis for optimism. So yes, if the political appetite is there at the local level, I do think we could see private capital put to work in support of community infrastructure needs. So what is infrastructure? A refresher. It's generally thought of as large, capital-intensive assets that provide essential services over a long service life. The sectors, transportation, energy, water, social, all have the role of providing essential services that underpin broad economic and community activity. Common characteristics which set them apart from other alternative asset classes: long useful lives, stable cash flows with a full or partial hedge against inflation, high barriers to entry, and low price elasticity of demand. From the viewpoint of private capital, of course, it's an asset class, generally viewed as having a lower degree of risk and volatility relative to other alternative asset classes. Investors assess infrastructure assets in terms of risk and price it accordingly. We would ask, is it a core piece of infrastructure? For example, a highly regulated utility with predictable revenues and managed risk would be core infrastructure. Is it a core plus infrastructure? In which case it would maybe have a higher risk profile with perhaps demand-based revenues and some management risk. Or it could be opportunistic infrastructure, which usually means it has a combination of revenue risk, construction risk, and management and technology risk. And each of these, of course, are priced with different return expectations. The challenge for local communities wanting to partner with private capital is in structuring the transaction to fit within these characteristics and presenting it to the right kind of capital. When it comes to private capital, there's good news and not so good news. Good news is that large pools of private capital have been raised over the last decade or so, with the growing expectation of significant new investment opportunities in the US and globally. Investors in these pools are pension funds and sovereign wealth funds, representing risk-averse, patient, long-term capital looking to match long-term pension obligations with long-term cash flows. The not so good news is that most of these large funds have substantial minimum equity criteria and are attracted to sizable assets, such as toll roads and sea at airports and large water systems. And conversely, the majority of America's infrastructure needs are smaller and local, and the preference for mega projects by large capital leaves cities across the US with less obvious access to private capital. Local projects are simply seen as not big enough, complex enough, or sufficiently revenue generating to be attractive to these large funds. And as a result, local water, sewer, transport, and other infrastructure needs often have trouble finding the right kind of private capital. Clearly, there's an opportunity for smaller regional funds. And there are good examples of smaller regional infrastructure deals being done that support the case for such funds to be raised. And as a side note for perhaps discussion on another day, smaller regional funds would likely have a different cost of capital from the larger global pools. And this would bring us back to my earlier point of aligning projects with the right kind of capital. In any event, the mechanism for investing private capital in public infrastructure is via a public-private partnership. So what is a public-private partnership? A P3 is a performance-based, long-term approach to procuring infrastructure projects where the private sector assumes primary responsibility for financing, delivery, and ongoing performance of the asset. The term has come to refer to any structure where a public asset is financed under a risk-sharing agreement between the public sponsor and private capital. Most commonly, we hear of design-build finance or design-build finance operate and maintain agreements, DBFOM agreements, where the benefits include expedited delivery, on-budget delivery, and efficient life cycle O&M or operating and maintenance costs. A foundational but often misunderstood truth about P3s is that ownership of the asset does not change. From a government's perspective, a P3 provides an alternative source of funding without the need to issue additional debt, along with the potential for significant efficiency gains from incentivizing the private sector to deliver and manage the asset to best practice standards. And there are many examples of how these efficiency gains exceed any cost of capital concerned with the use of private capital. There are a number of models for this risk sharing. The primary risk being revenue. Is it a demand risk left with the sponsor, or is it transferred to the private sector? Further risk mitigation occurs through fixed price construction contracts, best practice operating standards, long-term maintenance obligations, and of course the handback provisions. Including, the governing document in P3s is typically a concession or a long-term lease. And I have included several diagrams of examples of concession models. The first being a basic P3 model structure, which you would see in a design, build, finance, operate, and maintain agreement. You can see from this chart that at the top of the stack is the public sponsor. That sponsor contracts with a concessionaire, which is formed with the delivery team, and the concessionaire is capitalized with private capital and with debt from lenders. In the next slide, you can see a classic brownfield concession structure, which is pretty similar in structure to the design-build model. More about allocating that risk we were talking about. Investable and bankable projects are dependent on long-term predictable cash flows and an appropriate risk sharing. And risk varies widely between greenfield and brownfield projects. Greenfield projects are often difficult to structure for private capital because of the complexities of allocating risk, particularly revenue risk, where demand is dependent on untried demand forecasting. Many times the public sponsor of a transaction is better positioned to assume some of these risks for some or all of the project period. Getting this allocation right makes the difference between an investable and bankable project or not. For example, private capital is generally ready to assume development and construction risk, including fixed price, on-time delivery of a completed project, meeting all scope specifications and available for use. Private capital can likewise assume operating and whole-of-life costs for maintaining the asset and commit to handback requirements at the end of the project life. Arguably, the public sponsor is better positioned to retain other risks, such as environmental and permitting risk, and particularly demand risk, at least until demand history has been established. This aversion to demand risk extends to any project where the private capital is required to obtain bank debt on long-term patronage forecasts without the benefit of a proven track record of usage. Contrast this with a brownfield project. A brownfield project involves an existing asset where the sponsor is seeking additional financing by monetizing the asset for various reasons, to finance the expansion of the asset, to meet growth requirements, to finance deferred maintenance beyond its own means to pay, or to recycle capital into new infrastructure. In contrast to a greenfield project, brownfields have much higher degrees of certainty around demand, rates, operating costs, historical capex, and historical maintenance costs, but still leave the demand, still leave the DBFOM risks of the project with the private capital. I mentioned availability payments as an alternative to unproven demand risk. So what are availability payments? The public sponsor engages with private capital through a P3 and makes payments to the concessionaire based on the availability of the asset after construction. The payments are at risk and reduce if the asset is not available on time in the agreed condition. So one way of dealing with demand risk is to use an availability concession model rather than a demand risk model. A hybrid structure may be another way for dealing with demand risk. A greenfield demand-based project might be contracted initially as an availability payment concession, where the public sponsor pays an agreed revenue stream to the concession until such time as the demand meets projected usage. During this period, all tolls would be collected for the benefit of the public sponsor and used to defray the availability payment. Thereafter, availability payments would cease and the demand risk would transfer to the concession, hence a hybrid of the demand and the availability models. This example of a hybrid shows how a public sponsor might make an unbankable deal otherwise bankable by backstopping its own demand projections, and there are many variations on that theme. As we've noted in the case of revenue-producing infrastructure, these availability payments would be funded by the public sponsor's receipts. But what of non-revenue-producing assets, which comprise a large proportion of our so-called infrastructure deficit? The critical levels of deferred maintenance across the US bring with them a high cost of inefficiency, lost revenue, lost productivity, and in just keeping the lights on. Remediating deferred maintenance and upgrading infrastructure brings with it an efficiency dividend that could be shared, used to finance project delivery, and to fund availability payments. And there are many examples of this efficiency dividend being used to fund infrastructure upgrades. An alternative approach to funding infrastructure would be monetizing and recycling capital. Recycling capital by monetizing an asset is to transfer the right to the asset's cash flow to private capital for an agreed period under a long-term concession agreement in exchange for an upfront payment equivalent to the risk-adjusted present value of those cash flows. The upfront payment allows the recycling of capital from that asset into the repair or construction of new assets. So one obvious way to finance new infrastructure is to monetize existing brownfield assets. Again, commonly misunderstood is that ownership of the underlying asset does not change. It is the obligation to operate and maintain the asset that's transferred to the private sector, along with an obligation to hand back the asset in agreed condition at the conclusion of the concession term. The public sponsor can expect to receive a significant upfront lump sum that it can use to pay down existing debt as well as the funding of new projects. In addition to debt or bond reduction, the public sponsor would benefit from a cash infusion, avoidance of its backstop liability, improved credit ratings, and a transfer of risk to the private sector, including the operational and maintenance costs. The ability of communities then to utilize private capital in solving local and regional infrastructure will depend heavily on community buy-in. P3s are often seen as private capital investing in projects to make healthy profits to the detriment of a community's needs. This overlooks the benefits offered by P3s in terms of overall costs, accelerated program construction, and long-term maintenance costs, and handback condition requirements. And as we've discussed today, P3 financing solutions provide benefits which, taken together over the whole of life of the project, result in lower cost. As I said at the outset, if the political appetite is there at the local level, I do think we could see private capital put to work in support of community infrastructure needs.
Thank you for that presentation, David. It's very enlightening. I think that raises some questions that I think we'd like to talk about as a panel at this time. One thing I know it raises as a question is there's lots of conversation about financing transactions and how there are different financing mechanisms, but there's also the question of funding. What are the funding sources that are potentially available? Amy, I know, what do you usually see when you're looking at people talking about funding P3s? Is it project revenues or is it more?
Well, really, it's going to be both. I mean, one of the things that David mentioned, David, and you and I both work on are traditional revenue bonds, and the marketplace for tax-exempt bonds for municipalities and localities. We also see, I see a lot of federal loans and federal grant funds. David, on the funding side, yes, primarily you're seeing different sources of revenue from, whether it be the taxes or the tolls. You also see grant funds that come in that aren't repayments, that differentiate themselves from financing. Tax revenues and other federal funds is primarily what I'm seeing in the marketplace, which of course is you distinguish between the financings that David's been speaking of.
Right, and I think some of our watchers may know that there's some federal funding available for so-called PABs, private activity bonds for transportation assets. And these are actually tax-exempt debt that's allowed to be done with the private investment DBFOM model. But David, you and I have talked about the fact that many governmental units want to use a significant amount, or they're leaning towards tax-exempt bond debts. Have we seen tax-exempt financing combined with private sector capital in some of these transactions?
Yes, we have, as a matter of fact, both fully private concessions and what we often refer to as conduit financing, where private capital might underwrite the bond issue, but the the bond issue itself is done through a tax-exempt authority.
Right. And one thing I'd like to mention is that it is an absolute truth that the ownership of the asset for state law purposes in the P3s that we have seen doesn't change from the governmental unit owning it. But sometimes the tax lawyers can get tricky, and for federal tax purposes, there can be a transfer of the asset.
David, one thing I want to interject with that too is that one of the benefits we see the P3s, particularly if the governmental entity retains the asset, is property tax abatement, so to speak, and so that there can be some benefits too at the local level for having the governmental entity maintain ownership.
David and Amy, do you think traditional public sector procurement is going to still be used most of the time? Or P3s, are they impinging on the thought process? What I've seen in my practice is more people who are saying, that's an alternative I'd like to explore, and at least they talk about it at the beginning of the transaction, but they may never get to an RFQ or RFP stage.
David, I'll jump in and then turn it over to our colleague. What I'm seeing is a question of debt capacity, in all honesty, and a lot of it has to do with the recent change in the economic downturn as a result of COVID. And one of the things I think that a lot of governmental entities are exploring is a way to finance projects without incurring additional debt that maybe their balance sheet can't hold. So I think P3s are going to continue, and we'll probably see an uptick, quite frankly, although I don't think that there'll ever be a movement completely away from, for example, taxes and municipal bonds, but where the interest rates go will also play a role in that as well.
I would agree, Amy, and I would add just a couple of thoughts. Firstly, I think there is a traditional procurement process that is the natural bias of local and state government. And so to move beyond the traditional procurement process requires encouragement, if not a champion. Having said that, there are some jurisdictions that still lack the necessary P3 regulations, David, and you're probably better positioned than I am to speak to that. We're seeing them come across the country more and more, but that's still a matter of enabling legislation to actually allow P3 to happen.
Yeah, one thing I'd like to mention is that, and not having surveyed every state in the union, but in particular in Ohio, if you look at a national survey, it will tell you that Ohio has a P3 statute that applies only to the Ohio Department of Transportation. And then it will tell you that the national survey will say there's P3 legislation that's been introduced but not yet approved. But if you ask the public and project finance lawyers, they'll tell you we actually have P3 legislation. It's just not labeled that way. So it's always good to consult with someone who's an expert in the local jurisdiction and not just rely on a trade association to tell you whether or not a P3 is possible or not. In addition, sometimes the local home rule power of some jurisdictions really helps. I also wanted to ask David, because you talked about the big funds wanting to work on larger projects, obviously. Do you think we're going to see P3s for private projects, capital projects that are in the $25 million range, the smaller range? What's going on with that?
That's a very interesting question, because I think that's the neighborhood where a lot of more local transactions are going to be found. So the real question is, can regional pools of capital be assembled to address smaller deals? And I think the answer is yes. We've seen quite a number of smaller deals, and I would offer for evidence of that the project in Michigan, where I think some serious amount of relighting, street lighting was done, both in the city of Detroit and at a state level. There are examples of bridges being collected into groups of bridges, 500 at a time, for example, and funded at a local level with amounts of equity that still are below the threshold for these large funds. So there are examples of smaller local deals being done, but I still think that there's a need for regional pools of capital to be assembled to make that more efficient.
Thank you.
I will also say that one of the things that we've been doing in West Virginia to try to be more creative to get deals done are frankly using the various economics tax credit incentives. So for example, we're seeing an uptick in new market tax credit deals in West Virginia. We've historically underutilized that program, and more recently different governmental entities have been able to take advantage of that, and that has helped cobble together the capital stack to get some of their projects done. So I do think that there are ways also to look beyond the traditional private capital that's hopefully still remains on the sidelines, and look to ways to get the projects done. Now, I will say, new market tax credit programs are complex, and they involve a lot of professionals, so they're not necessarily inexpensive. So they usually say you want a project of over 10 million, but I will tell you that I've done projects below that where there still was a significant cost savings to the ultimate issuer. So there are ways to get deals done that aren't in the traditional format.
Yeah, and I might want to mention as well that there are P3 transactions that have been done even before P3s was a label that anyone understood. And in the last recession, we're now suffering through the COVID-19 recession, but in the last recession, 2008 and 9, I know I worked on a couple of large commercial building, office building projects that had a significant effect on the cities that were funding them. And the capital stacks ended up with, over 30 funding sources. They were not fun to do it all. But what happened at that time was that you would get the cities who were willing to put up soft pledges, like subject to appropriation pledges to backstop transactions, maybe add a reserve fund to a financing. And it seems to me that as we move forward, needing more capital now, that our governmental institutions that are financing infrastructure, they just may want to finance another way to help get the private capital into the transactions. What I'm thinking of is making availability payment pledges that, private capital will look at and then evaluate. So David, I think the private capital is very comfortable with an availability pledge as long as they underwrite it, right?
That's correct. That's correct. And to go back to that earlier question that you asked, I think the other important ingredient in all of this is what I would call perhaps transaction certainty. As our market has been evolving, and as people have tried to involve private capital more and more in these sorts of projects, private capital has been asked to participate in transactions. And we roll up our sleeves, we go to work, we go through a process, only to come to the end of the process and find that private capital was never going to be a politically acceptable solution. And time again, we burn the dry powder doing these things, only to end up with no transaction at the end of the day. So to encourage private capital to be more engaged in this space, we're going to have to see more certainty of process.
David, let me ask you this too. I kind of made the comment that hopefully there's still a good amount of private capital on the sidelines. Is there still private capital on the sidelines interested in these kind of deals? Has the effect of COVID and frankly what the impact all the way down to the state and municipalities, what has that effect has that had on the way you look at deals? And is it still looking for reasonable rate of return, some sort of certainty in terms of the risk return and the longevity?
Great. That's a really interesting question, Amy. I think there are a couple of answers to that. The first is that demand-based concessions might have a different set of risk factors now than they had before. But even availability payment models need to be looked at in terms of, is there a change in behavior? So in the first category, I think private capital will be as interested as it's ever been in looking at demand-based concessions. The calculation of demand risk may be different for a while. But overall, if you have historical demand that's measured and you have some faith that vaccines are going to come and people are going to go back to normal at some point in the future, the management of that demand risk is not that difficult to project. And so the short answer is that demand-based concessions will be as interesting to private capital as they ever have been, and it will just be a process of understanding interim risk in the demand calculations. More broadly though, and particularly for availability payment concessions, if we think that there are behavioral changes, then that's a whole different category of analysis. I haven't been involved in any transactions recently enough to know how to speak to them, but I do know that we think a lot about whether downtown assets will be utilized in the same way post-COVID as they were pre-COVID. Are people going to work from home more? Are offices going to be less occupied? Will fewer people travel into the city area on a regular basis? While they may all travel back into the city at some point during a week, will they do it all each day, every day as they used to? And what impact will that have on parking, on office utilization, and other public infrastructure?
One question I wanted to ask, having just purchased an all-electric vehicle, is, and this involves transportation infrastructure. David, do you think, and the fact that GM is now advertising the new Hummer truck with 1,000 horsepower from their new Ultium battery plant that they just put in Ohio that'll produce batteries in a year. Do you think the conversion to electric vehicles and alternative energy sources will alter the investment strategy of P3 investors, i.e. will it make U.S. investments more attractive, or will it just mean there's an asset class for charging stations?
There are a couple of aspects to the question, David. The first has to do with the way we have traditionally financed road construction, which is through a gasoline tax. And as electric vehicles gain more market share, we can expect to see the gasoline tax continuing to decline and providing less revenue for the maintenance of our roadway systems. And so I would expect to see our various jurisdictions to move more and more towards a vehicle miles travel tax in lieu of a gasoline tax to replace those revenues. The other aspect to your question, I do think that charging infrastructure will be a new asset class, but that comes with it the need for us to address the availability of power that would not currently be available from our current energy infrastructure.
Thank you. Thank you for joining us today. This video was provided by Frost Brown Todd and its affiliate FBT Project Finance Advisors and presented on CDFA TV. And I'd like to thank David Teed and Amy Conderas for joining us on this project, and hope it's helpful to all.